prime rate, HIBOR, LIBOR, COF. What do all these mean? No worries, we're going to answer all of these questions in this video and detail how you can benefit from building assets quicker using these low lending rates, specifically to the case of premium financing. Hey friends, welcome back to the channel and to my favorite asset. In this video, we're going to go over why should you borrow, how banks view risk, and as well, what are the current premium financing rates so that you can take advantage of them. Let's have a look. Borrowing money allows you to purchase assets using a small amount of your own money, but controlling the benefits of something much larger. This is what we call leverage and OPM. Not just anybody though, specifically the banks. And there are many benefits of accessing and using this leverage to build asset versus not using leverage at all. And in many instances, the bank actually acts as your business partner to co-invest to purchase specific assets. So in a nutshell, you're borrowing money from the bank to accumulate wealth. And this leads to faster wealth accumulation. But don't just borrow for the sake of borrowing. Only borrow if it is good debt, which means there's money that comes into your pockets, versus bad debt, which takes money out of your pocket. And there's only one rule here, which is to make more money than your borrowing costs. Or in other words, be net positive, meaning your income or growth is greater than your expenses or the cost of your loan. And for that, we need the cheapest type of lending available. Premium financing offers this, a very inexpensive loan that is used to purchase an asset that only compounds and grows as the years go by. So for this premium financing setup, you're going to need a bank. And what does a bank do? So to recap, a bank basically provides a safe place for people to put their money. In return, this money is lent out to other people or businesses, and an interest is collected by the bank. There's also various charges that the bank collects, and also fees for portfolio management, or even one-off fees, for example, issuing a mortgage to a mortgagee. But the question is, will they lend to anyone or to buy anything? And the answer is, it really depends on the underlying. If there's a guarantor to guarantee the product, or what is the underlying? What are you borrowing the money to purchase? In simple terms, this means how risky is the loan? Will the bank get its money back? When will this happen? Will the lender default on his or her side of the deal? So I view it like this. Basically, there are loans for any purpose and loans to purchase assets. For loans for any purpose, the bank doesn't care what you spend the money on. It also considers it sort of unsecured and is based on your personal relationship with the bank. These are generally smaller amounts and of shorter duration. Just how small and how short, we'll have a look in a minute. But basically, they are packaged in various forms and names. For example, tax loans, personal loans, credit card consolidation loans. To give you a feel, there are personal installments loans, such as the one from Standard Chartered at the top. The maximum loan repayment is sort of 60 months, so that's 5 years. And right now, its APR, or annualized percentage rate, is 1.18. Now this number is actually, it fluctuates with the amount you borrow and how long you borrow for. So we'll go over that in a little minute. Then there's also tax loans, i.e. the one from Citibank here, and the APR is as low as 1.38. Okay, this is based on 1.5 million and a repayment period of only 12 months. If we scroll down a little more to have a look at some others, personal installment loans, Standard Chartered has a debt consolidation program, slightly more at 2.15%, but you can go to 84 months. Okay, so if we scroll down a little more, DBS has a personal installment loan. Once again, this is about 3.7%, so slightly more, but you can borrow up to 20 times your monthly salary or 2 million, whichever is lower, and so on and so forth. So basically, there's 3 different types: tax loans, personal loans, and debt consolidation loans. And there's also a credit card type of loan, which is based on the credit limit of your credit card. So let's reference HSBC for this. And if we have a look at it, basically it's at about 5.8%. And if you default or if you don't pay, it's at about 31%. So this is actually quite expensive if you don't pay on time. But it's based on the credit limit of your credit card, so you do have a relationship there. However, the disadvantage is if you needed to use the credit card for any emergency, a large amount, all your credit limit is gone. So this puts a significant limitation on that. So for loans to purchase assets, generally these loan amounts as well as the terms and conditions are a function of the underlying asset. If you default on your side of the payments, the bank generally repossesses the asset. And the bank's not silly because these assets generally hold their value very well and or appreciate over time. And so these loans are generally much larger in terms of scale, in the millions. And they are of much longer duration, 30 years or up to age 100, for example. And there are two types. One we know very well, which is property. Property loans are called a mortgage. And for a mortgage, generally you have to have principal and interest payments. They are generally for 30 years maximum. And you can generally borrow sort of 50% or up to 90% here in Hong Kong, depending on the size and price of the property. The second one is insurance single premium products. These type of loans are called the premium financing loans. And for this, there are only interest payments. You can borrow up to age 100. And the amount, you can generally borrow 70%. It's worked on a day one surrender value amount. So those are the two types of loans that are asset-backed that you can access. So what are these ultra-low rates that we use with premium financing? Well, let's have a look at each of them. So first off, we're going to have a look at prime rates. And prime rates are generally those that the banks charge preferred customers or those with good credit ratings. And it's basically used to determine borrowing costs. And for Hong Kong, prime rate right now, if we reference Hang Seng's website, is 5%. And it generally doesn't fluctuate too much. You can see that in 2019, it was 5%. In September 2018, it was 5.125. In March of 2008, it was 5.25, etc. So it's set by the Monetary Authority of Hong Kong, and it generally doesn't change too much. So HIBOR stands for Hong Kong Interbank Rate. And HIBOR is a benchmark basically denominated in Hong Kong dollars for lending between banks in Hong Kong as well as the Asian economy. And if we have a look at HSBC's site, you can see that the rate is basically 0.3 at the moment on March 29th. If we have a look at a bit further in the past, let's say on February 4th, it was 0.17, etc. So it is on the rise slightly. Next is LIBOR. And LIBOR stands for London Interbank Rate. So basically it's a benchmark that is used in London for lending between banks every day. And currently we have 1 month, 3 month, and various durations of LIBOR, and also different currencies denominated in LIBOR. Most of the banks use 3-month US dollar. So if we have a look at the 3-month US dollar LIBOR rate, you can see the chart for the month is actually on the rise. Last year, it was quite low, and then all of a sudden, the beginning of this year, it's gone quite high. But for the full term, actually, it is still quite low. Now, this is gradually being phased out simply because it is quite volatile. But if we have a look at the 3-month US dollar LIBOR rate here, currently on March 28th, it's 0.99. If we have a look at January 4th, it's only 0.30. So it is actually quite volatile. But it's also one of the interest rates used for premium financing. Okay, and the last one is cost of funds. So cost of funds refers to the amount spent by a lending institution to acquire funds to lend to you. If we reference the Hong Kong Monetary Authority, basically it's also called a composite interest rate, which is the measure of the average cost of funds. And this is what the banks refer to for that amount. And if we have a look at the trend down here, the composite interest rate is actually 0.21 at the moment. Prime, which is actually the best lending rate, is at 5.25. So you'll see in the next few slides that everything is referenced to this COF as well. So that's what cost of funds is. It's basically the composite interest rate. All right, so putting it all together. Now that we know what HIBOR, LIBOR, cost of funds, prime rate, their definitions, and roughly how much they are, we can have a look and apply it to premium financing terms and conditions. So if we have a look at this specific slide, we can see that for OCBC and Wing Lung banks, there are certain assets you can purchase with premium financing. In this case, Wealth Icon Supreme, or for example, Noble Fortune. There's also minimum loan amounts, and in this case, generally the minimum loan amount is $1 million. You have to be of a premier banking status or a Sunflower or Prestige type of banking status, and that requires you to open an account there to get the loan, where you have to remain and have sort of $500,000 or $100,000. And for that, depending on how much you put with the bank, here are the terms. So the lending rates are, if we look at OCBC on this side, 3-month cost of funds plus 1.7%. Now we had to look at cost of funds, they're about 0.21 as we just said, right? So roughly the effective rate is about 1.9. And the next tier, if you put a little bit more money, or if your loan amount is between 3 and 30 million, then the cost of funds plus 1.55 or about 1.8. The next one, etc., etc. So you get the idea. So every tier that goes up gets cheaper, which means that you're borrowing more, which means you have a more requirement for that asset to be there, like you have more money with the bank. And same goes with Wing Lung Bank. So minimum loan amount 1 to 10 million. This one's based on HIBOR 1 month plus 1.75. So if HIBOR is about 0.3 plus 1.75, that's about 2.05%. But it's capped at prime minus 2.25, for example. And if prime is 5.25 minus 2.25, that means the net cap is 3%. So you're never going to pay more than 3% in this case, provided prime is at 5.25 and doesn't change too much. And so on and so forth. For example, if you're borrowing much more above 1 million to 30 million, 10% of the loan amount or 30% of the loan amount, you have HIBOR 1 month plus 1.55 only, or plus 1.5, and a cap of prime minus 2.25 or prime minus 2.5. So basically you get the idea. So in a nutshell, basically this takes advantage of low lending rates, and the low lending rates for HIBOR being at about 0.3 right now, cost of funds being at about 0.2 right now, you can see generally you're effectively going to pay about 2% or less. But if all of a sudden it goes up in terms of the interest rates, you're not going to be paying more than, say, 3% for Wing Lung in this case. So all in all, the income that is produced from your asset, from dividends or interest, is actually much larger than the cost for the loan. This facility can actually be secured for a very long time at a more or less predictable rate. This is what we call premium financing, and you can actually compound on the bank's money for much, much longer, accumulating much more wealth. So I hope you found this video useful on demystifying what HIBOR, LIBOR, and cost of funds is. If you want to check out our video on why I think this is the safest asset, kindly click the link at the end of this video. That's it for this one. Thank you for watching, and I hope to see you in the next one. Thank you.